Hello traders, Igor here, MrTopTick.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing, and if you enjoy content of today's video, please make sure to give it a like. Today we're going to look at a 112 bear trap in the S&P 500. We're going to talk about a basic structure of this trade and a few steps that we took along the way managing this trade from the start up until today. Today is March 23rd with 1 day until expiration. So this trade was put on February 2nd. We chose 24th of March expiration cycle with 50 days until expiration. We bought to open a 30-point wide put debit spread, and we financed this put debit spread by selling 2 times as many 34.50 puts naked. This produced a net credit of $10.90. This trade has 3 potential outcomes. If S&P at expiration is above $39.90, we get to keep $10.90. If we are inside the bear trap, somewhere between $39.60 on the high end and $34.50 on the low end, if we are inside of this area, we're going to make money from short out of the money puts going to zero. They're going to expire worthless, and the 30-point wide put debit spread is going to expire for its max potential value, which is 30 points or $3,000 per one spread plus $10 that we collect up front. So we have a potential of making close to 40 points or $4,000 per one bear trap at expiration. So the trade started off. Let's take a look at the Greeks real quick. So this is a positive delta trade, meaning that this trade will benefit from S&P trading higher. And if S&P trades lower, we are going to accumulate losses. This trade also has positive theta, which means that every passing day, net value of all options that are part of this trade is going to increase, right? We have a lot more premium decaying than what we had spent on buying the 30-point wide put debit spread. And a very important component that is often overlooked is the Vega. We are short Vega to the tune. This is a 10 lot, so we're short about 2,400 Vega, which means that for every 1 point change in implied volatility, this trade is going to either increase or decrease by about $2,400. We can take a look real quick. If we were to drop volatility by just 2 points, right, we have minus 2,400. If we drop it 1 point, this trade is increasing by about $2,400. And if we drop this volatility by another point, this trade is showing an unrealized profit of about $4,800, and that is due to implied volatility decreasing and a short Vega component is playing into our hand. So this trade started off 50 days until expiration. There was really no management that needed up until March 6th. So we'll go forward to March 6th. Here we are. This is March 6th. We have 32 days have gone by. We have 18 days left until expiration. This trade is a very profitable one so far. What I ended up doing, I decided to go ahead and let's have a look at the value of the short puts that are naked out of the money. We can look at the original trade price, which was $9.60. These puts are now trading for about 80 cents a contract. So most of its value has already decayed. What I ended up doing, I ended up buying to close 20 of the 34.50 puts that were naked. And I also went ahead and I sold to close 7 out of 10 of the put debit spreads. I paid 90 cents to close the short out of the money naked puts, and I collected $7.25 credit for selling to close the $39.90, $39.60 put debit spread. And this is what my risk graph looked like after I made such adjustment. I eliminated all of my downside risk, and I also increased my max potential reward if S&P was to remain above $39.90 at expiration. Now we can go forward to where we are today. Today, S&P is trading at just over 4,000. We have remaining 3 of the 39.90, 39.60 put debit spreads that have 1 day until expiration. And what I'm going to do is I'm going to go ahead and enter a sell to close order to get out of the remaining put debit spreads. They're currently going for about $8.30 credit. So all in all, this is a very profitable trade. We actually ended up making a little bit more than what we initially took in. We did eliminate downside risk by getting out of the money naked puts early, and we also were able to sell to close the 39.90, 39.60 put debit spreads early, and we're going to not wait until tomorrow and close out the remaining put debit spreads, collecting about $8.30. And net on net, this trade ended up on a 10 lot, a winner to the tune of about $16,000. I hope you enjoyed this video. I hope you learned something new. If you have any questions or comments, please leave them below. As always, take care of the risk. The profits will take care of themselves, and we'll see you in the next one.